Iran, the bully of the Middle East, must now make peace. If they do not, future attacks will be far greater and a lot easier.
President Trump, they're speaking at the White House following U.S. strikes on 3 Iranian nuclear facilities. You're watching The China Show. I'm David Ingles in Seoul.
And I'm Yvonne in Hong Kong. Our top stories this morning. Crude prices and haven assets rise following the escalation of the Middle East conflict, raising the risk of a wider war in the region and disruption to global oil trade through the Strait of Hormuz. Iran launches a fresh wave of missiles against Israel as it warns of everlasting consequences after the U.S. attack. And China condemns the Trump administration's move, with Beijing saying it's willing to join diplomatic efforts to stabilize the Middle East.
A pleasure to have you all join us. There's lots to get through as we make our way into the opening bell today, Yvonne. And I think the biggest difference I've noticed so far, and it's early Monday, just to caveat that, compared to this time last week when things kicked off, was we're getting a lot more responses coming through right now. We'll talk more about the Chinese response, of course. And in the last couple of minutes, the South Koreans have come out where I am here. They talked about how they'll be watching markets very closely. We've heard from the Thai exchange operator that they'll be limiting the downside and some of the extreme price moves by half today going into this open today. And just in the last few minutes, I think we're also hearing from the Japanese Foreign Minister, Yvonne, as well.
Yeah, certainly we're heading into unprecedented territory here when it comes to the Middle East, and what we heard from the U.S. and their response in these airstrikes over the weekend. And that's why I think you are hearing more of the market regulators talking a little bit about the warnings out there. The shipping industry certainly has been on high alert as well. But interesting enough, you take a look at the knee-jerk reaction that we saw with oil prices briefly, surging a little bit, but really we've come off a little bit now this morning already.
Yeah, we have. In fact, let's have a look at where we are market-wise going into the open today. And certainly it is a fairly nuanced narrative and take when you look across these markets, right? 27 minutes to the opening bell. And as you can see, a two-day look Friday and where we are Monday morning, Asia-Pacific, that vertical leg lower in the U.S. dollar. And as you can see, compared to that low point about 3 hours back, we have certainly come off lows of the session. All that being said, markets are either putting in some hedges or staying out of this altogether. When you look at the Brent curve, let's start with that as well, right? So in terms of where we are as far as the range is concerned, we're on the higher side compared to the highs of last week. But as you can see, though, we're nowhere near the 3-4% pop that we had in the opening minutes of the Monday session. Same goes with West Texas. Let's have a look at that side of the energy curve as well. And that, of course, is, $1 or $2 lower across the curve compared to where you are on Brent, but similar gains as you can see on your screens. Now, make no doubt, it's still a very risk-averse session out there when you look at things like gold, for example, the Japanese yen. We also have the Swiss franc coming up on your screens very, very shortly, and VIX futures, as you can see, of course, tacking on about half of 1 point. Now, Asia-Pacific looking like this. Asia, you're getting Taiwan coming online. The Nikkei 225, we talked about the Kospi index, of course, where I am, and regulators looking to watch these markets with a closer observance today, given, of course, everything that's going on. Kospi's down 1%, and we're softer in futures, Yvonne, by about half of 1% going into the Monday session.
Yep, certainly there is a bit of risk off here this morning as we continue to watch the latest headlines crossing in the Middle East, and Iran now saying on all options for retaliation are open after the U.S. struck 3 of its nuclear sites on Saturday. Meanwhile, President Trump has warned of greater attacks unless Iran makes peace with Israel. Let's bring in our Bloomberg economy editor, Michael Heath. He joins us with the latest right now. We're still waiting for that full damage report from these U.S. strikes, Michael, but to what extent do you think this attack from the U.S. has derailed Iran's nuclear facilities?
Well, the expectation, Yvonne, is that this, the Fordo site was the main one that had to be hit. But and as you mentioned, it is too early to make any judgment on how much has been done, whether it's Israel or the IAEA or the US. No one's got a really clear picture. But people have been looking at satellites and just questioning how much damage has been done. Now, some of the US military officials said it would be likely, or it's a normal practice for them to have to go in and do follow-ups once they've assessed how much damage has been done. So we're not really in the clear on that, but it does take us obviously into new territory here with once we have the US involvement, just how, as you mentioned, how Iran will react. But yeah, the big question at the moment is just how much damage has been done, and of course there's Iran has this highly enriched uranium to about 60% that the International Atomic Energy Agency has lost track of over the past week. Iran acknowledged that it's moved it, so this is not, no one's really sure where that is as well. So there's a few moving parts, but the main one is people will be trying to assess that initial damage.
Michael, David here, do we know anything more from what Iran has either said or done in the last, let's call it 18 hours or so, to just inform us of what the potential response might be?
Yeah, I mean, look, David, we've had the Supreme Leader who, at the end of the day, he makes the big calls on all of these things. One of our reporters was just noticing that he hasn't actually spoken publicly since the US attacks. It's been about 24 hours now. And on social media, etc., there's clips of his old, text of his old speeches and things like that. And the word sort of coming out is that Iran will respond. Now, on one hand, this is, it's a fairly aggressive regime, and it would like to maintain its prestige, but it's also very, very pragmatic, people have said as well. So you've got this unusual combination of quite ideological, but when it's backed into a corner, it can be quite pragmatic in terms of survival. So the real question is, will they try and respond against US bases or US personnel, or even worse, perhaps, they attack the Gulf countries, even though the relations between Iran and the Gulf countries have improved a lot. I mean, they've got a lot of options there. The other thing is that the question that's sort of out there is that Israel has been targeting the launching, the missile launching pads that Iran has. So there's also questions about just how much ammunition or hardware they've got there, or the ability to deliver that hardware anyway. So again, a little bit like the damage assessment, it's sort of watch and wait. And there's a degree of hope out there that perhaps Iran looks at it and says, this isn't worth pursuing. Let's try and come back to the negotiating table. And it certainly seems like that's what President Trump was suggesting that they should be doing. Israel has said that it still has on its list of targets, it still has some to go. But I think in general in the developed world, everyone would love to see some dialogue now. It sort of feels like that the strikes that needed to take place to set back the program, not months or a year, but years now, have taken place, presuming that they have actually succeeded, and that everyone would like to negotiate. But it's really up to Iran. Does it judge that it needs the boost to prestige? That's the question.
Michael Heath, thank you so much. Our Bloomberg economy editor joining us with the latest and some context there. Joining us now for more insights is Matt Gertken, Chief Geopolitical Strategist at BCA Research. He joins us today. Matt, good morning from the Asia Pacific. Thanks for joining us. I have to mention that you guys saw this coming. So I want to understand, now, so what now? In other words, let's start with what you think is the most probable response from Iran.
Yes, thank you very much, David. We did see it coming. In fact, we saw a general destabilization of the Middle East coming before the Hamas attacks. Then we saw Israel likely to attack Hezbollah, and then we saw that as a preview for an attack on Iran, and then ultimately American intervention. So the way we've done that is, first of all, to be nonpartisan and try to be empathetic to all the different actors, looking at their national interests across time and across regimes, but also then to really assess the situation, which was that with each step of Israel's counterattacks following the Hamas incident, we saw weakness on the Iranian side. We saw a collapse, ultimately, of the arc of influence that they had tried to create all the way to the Mediterranean. And this just continues to draw in Israeli and then ultimately American intervention because the Iranians can't do anything about it. Now, maybe we're going to find out that they've been withholding the ability, which they do have probably, to affect regional oil supply. And I think that they actually will pull that trigger, even though in the markets that's a bit of a debate.
Okay, they will pull that trigger. Do you specifically think blocking the Strait of Hormuz, Matt? I mean, most people are gaming scenarios. It's either full closure or nothing, but is it more nuanced than that?
Yeah, I think it's more nuanced. I mean, here's the main issue is that the Israelis and the Americans have limited commitment to this war. They're both divided at home in their domestic politics. And the problem is for Iran, the problem is that they're not really suffering an economic cost for waging this war. So if Iran starts to dial up the pressure through the oil channel, then those two actors are going to have to start reassessing how much they want to push this. Now, the Israelis can push for quite a while, but then they ultimately run out of ammunition. Now, the Americans, their perspective is that President Trump knows from previous presidencies that an oil shock is very dangerous and very damaging for his administration. So I think that they would first start to derail oil production in Iraq and see where that goes. Does that signal to the Americans that they need to actually reduce their commitment to this war and sort of declare victory on what they've already done by knocking out the nuclear program for the most part? Or do they actually start to strike ships? And they could hit ships in the Gulf of Oman. They can hit ships even in the Indian Ocean, which we saw just a few years ago. There's different ways for them to do these things and dial up the pressure. But ultimately, if they think that the regime is in danger from Israeli action and American action, then yes, they could pull the Hormuz trigger.
Well, Matt, let's talk about that. What probability, or how are you thinking about that possibility? Regime change in Iran, and what lies on the other side of that door?
Well, it is absolutely essential to have a probabilistic assessment here because no one can see the future, and we don't want to add to the noise. Everyone has an opinion. The point is, in a context in which the U.S. has intervened to destroy the nuclear program, you should assign a higher probability to the Iranians attacking regional oil supply in order to create a cost to try to create a change in American politics through that higher cost, higher prices at the gasoline pump. But then the other thing is global attention. Iran doesn't want to be left alone. Of course, they are left alone. Russia and China aren't really capable of doing much about these attacks. But they don't want that to continue. In fact, they want all the countries in the world basically to be lobbying Donald Trump and saying, hey, let's not have a global oil shock and recession over this. Let's calm things down. And the way to do that is to threaten oil first and try to get that symbolism across and change behavior. If that doesn't work, though, and again, if Israel just continues to pound the regime and start to hit in very critical infrastructure in places where the regime starts to think they might fail, then that's where they could conclude that they don't have anything left. They have nothing left to lose. And that's where they could then try to pull the Hormuz trigger.
Yeah, and you say that against a backdrop where Iran does find itself more isolated, right? I take a look at their allies like Russia and China. It seems like they're only at this point offering rhetorical support. Hezbollah and Hamas either are unable or refuse to engage in all this right now. So does Iran continue to stay pretty isolated in this whole conflict?
Right, that's correct. They're completely isolated. And in fact, what we've learned, and I suspected this, but I think what the world has learned is that China is still a long way off from being able to project power in the Middle East. Russia's having trouble projecting power into Western Ukraine, not to mention the Middle East. They've lost their foothold in Syria, for example. So all of this suggests, again, that there's this extreme vulnerability of the Iranian regime. They can't really do anything about their circumstances right now. And that's why you assign a higher probability. And so I would conclude there's basically a 60% chance that they retaliate out of the desire to raise the cost of this war, knowing that the Americans are divided and don't really want to go all the way to try to create some kind of regime change. And the fact of the matter is there can't be regime change. Iran is a mountain fortress. There's no way anyone's going to invade with ground forces. The president's already said that there's not going to be any boots on the ground. All of this confirms in Iran's thinking that they can actually batten down the hatches and weather through this while they inflict a cost on the rest of the world. But again, I think they can dial that up. And I think the first thing we'll see is that oil production in the region, especially in Iraq, is probably likely to start to be derailed and disrupted.
All right, Matt. So whether it's oil traders out there or users of oil, for example, I mean, to your point, we don't really know, and this is really a spectrum of probability. So what's the likely range of oil prices you think the next couple of months here, because of the possibilities you've underscored?
Yeah, I mean, when we look historically at geopolitical crisis events in the Middle East, the median increase in Brent crude is about 8%. And then over a period of months, say 3 to 6 months, you can end up even higher, like in double-digit territory. Major shocks like the Iranian Revolution or the Iraqi invasion of Kuwait, they can even create much higher double-digit increases in oil price. So let's say we're at a fair value of around $60 per barrel, and we're moving toward 90 per barrel just to price in the risks here. Now, if there's no shock to the actual supply, if it just continues to be the case that Iran refrains from hitting oil supply, then the market's going to be very volatile, sort of dipping back down. But if I'm correct, and they actually do try to increase the price by hitting supply, and again, I give us about a 60% chance to that, then what happens is we move from 90 and maybe above. And it really depends on the magnitude of the shock. There's about 10 million barrels per day, very roughly, of spare capacity. If the shock is beneath that, then you get a price move, but then you get that price move coming back down because there's still enough spare capacity to adjust. But if you get above that, meaning that if Hormuz is closed, or if shipping in other ways is blocked, or if Saudi Arabia is hit, those are last gasp actions by Iran. But if they happen, then of course we would start to move toward maybe even a doubling of oil price. I mean, definitely over 100 per barrel.
Matt, it's so great to have you. Thank you so much for staying late for us. Matt Gertken, their chief geopolitical strategist at BCA Research, joining us from Kansas City this evening. And coming up on the show, we're going to track market reactions to the developing situation in the Middle East. Reed Capital and CBA will be joining us. Plus, Pacific Basin's CEO Martin Fruergaard joins us with his outlook for the shipping industry and how trade tensions and new geopolitical risks are going to be there when it comes to vessel movements as well as flows. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Well, I encourage the Chinese government in Beijing to call them about that because they heavily depend on the Straits of Hormuz for their oil. If they do that, it'll be another terrible mistake. It's economic suicide for them if they do it. And we retain options to deal with that. But other countries should be looking at that as well. It would hurt other countries' economies a lot worse than ours.
That was U.S. Secretary of State Marco Rubio there telling China it should ensure Iran keeps the Strait of Hormuz open to shipping. Beijing, meanwhile, has criticized the U.S. strike on Iranian nuclear facilities, saying again that it's willing to join international efforts to restore peace in the Middle East. Let's bring in our China correspondent, Min Min Lo, and tell us a bit more about that Beijing response.
Yeah, Beijing's response has been very consistent. It hasn't really changed. It's condemned Israel's attack. It's also condemning the U.S. attacks as well. There is a Global Times editorial criticizing the U.S. for escalating tensions even further, even though China has previously called on the U.S. to do more to calm the conflict. But I guess hitting these nuclear sites in Iran is not their vision of calming the conflict. And in fact, the Global Times editorial is saying that U.S. is escalating the level of weaponry being used by using these bunker buster bombs to achieve what Israel cannot. And Iran is likely to see that as an act of provocation. It's going to cause the conflict to possibly even spill over to the wider region. And that's what they are deeply worried about.
Min, the topic is also being discussed widely across social media. Could you just give us a glimpse of what the sort of more pertinent ones are?
Yes, this is very interesting to watch because people are discussing this very widely on Chinese social media. In fact, the top trending hashtag on Weibo today is that Iran has set an example for the rest of the world. And the gist of the comments there, they're all saying that Iran essentially is quite naive in some ways to believe that the U.S. is a trustworthy party here. And here's a comment that says, first, Iran was deceived by the U.S. into some negotiation which made Iran lose its vigilance. If we can flip back to the previous post. And then it was attacked by an American ally. It was resisting the attack. Iran had hoped for mediation from the U.S., but soon American bombing arrived. So it was all about how Iran is being squeezed by the U.S. And the lesson here for many Chinese people is that these appeasement tactics, they don't work, and only by fighting resolutely can you protect your own sovereignty. That's the lesson that many Chinese people are taking. But that said, China does have this long-standing policy of non-interference. So China is unlikely to wade into that conflict unless its direct sovereignty is being threatened.
Min Min, thank you so much. Min Min Lo, a China correspondent there with the latest take from the Chinese side of things, of course, and a response coming through as well there from the Chinese. Right. Very quickly, going into the open today, we have the fix. Two things. We have the fix of the day that's coming out on your screens very, very shortly, and also this sort of pull up we're seeing across the Shanghai crude space. So the fix, let's start with that, 717.10. We're also looking at, can we have a look at oil prices, please, in Shanghai? We're up 15 renminbi there, which effectively now puts us almost at par intraday to the high that we hit back in early February. And at about these levels, we're effectively at the highest here in 2025 so far. Plenty more ahead, including a full preview of these markets. This is the China Show.
Your agenda for today, as Dave mentioned, Shanghai crude certainly is in focus as we near that February peak in oil prices there. And we're watching very much so the defense-related stocks as well. The MSCI China has reached that 100-day moving average, so something key to watch as well. Interesting kind of taking stock about how, 8 shares basically have outperformed the domestic market for quite a while now. Zhejiang Shanghua Hong Kong listing here today. Still watching the energy space here. The Treasury Secretary, Financial Secretary Paul Chan is in Tianjin as well, or likely maybe to hear a little more about some of the Connect sort of announcements that we got in the last few days or so. And of course, still tracking that Hong Kong dollar weakness, Dave, this morning.
Yeah, I'm looking at that. It's now currently indicated at 784.99. So one of the stories we put out, of course, which was on Friday, was it did seem that we were indicated at 785, which might increase, of course, if not already, if is the operative word there. Any sort of intervention coming through out of the HKMA. But anyway, in any case, we're extremely close to the level. Underscoring the broader point, which I'm trying to make here, is the strength coming through in the U.S. dollar today, given, of course, what's been taking place geopolitically and the dollar catching somewhat of a bid. It's a dollar that's catching a bid. As you can see, equity markets are on the opposite side of that risk spectrum. We're back below the 6,000 level. We were above it earlier on S&P futures. European futures also coming online in the last, let's call it 1 hour, 15 minutes or so. Asia Pacific is down 1.2%. A lot of that is Taiwan. The Nikkei, the Kospi index is on offer about 1%. And of course, we're getting the initial pricing coming through. And speaking of Hong Kong, that's coming through on your screens very shortly. Hang Seng Index, Hang Seng Tech. And as Yvonne is pointing out, we did bounce off. And we'll see if that holds today. The 100-day moving average on MSCI China, 23.3 right now at Hang Seng Index. The Monday session, just over 3 minutes away. There's plenty to discuss and plenty to unpack. Keep it here. You're watching The China Show. Good morning. All right, welcome back. You're watching the China Show. Okay, so we're just getting more headlines coming through in terms of the market reaction here to what took place, what is still taking place in the Middle East. The South Korean won has now extended its weakness against the U.S. dollar to 1%. It's leading the declines across Asian FX and really underscoring the broad bid the dollar is catching going into the session today. Apart from that, it's oil for obvious reasons, but to a lesser extent, equity markets still down though. But it's not, no one's tossing everything out the window just yet, Yvonne.
Yeah, it doesn't seem like we're seeing panic selling. Certainly, that's one thing to watch because I think everyone's still watching what the next move from Iran is going to be and what sort of retaliation, what would that look like for this whole Middle East conflict. So certainly for now, there is a bit of a knee-jerk reaction, but as Dave mentioned, we've already pared back some of the initial sort of big drops that we saw when it comes to risk assets, though. So onshore markets are doing this, so slight pressure when it comes to equities here right now. You are seeing a slight bid across some of the CGB space here this morning, and we're watching very close to the commodity space, right? Shanghai crude, as we mentioned, right? 2% pop there at the open, and futures really kind of following what we saw with global crude prices here and really reaching that February peak. So likely we might see the highs of the year when it comes to Shanghai crude. Stocks are out of offer here this morning. Take a look at when it comes to some of the big names like CATL, Ping An, all seeing declines here. The tech space seems to be really feeling most of it in Hong Kong. Take a look at HS Tech. We're lower by about 1.4%. Hang Seng is also down about 1%. So we're seeing similar moves in the equity space, which, as Dave mentioned, up until now have been quite resilient in the face of all this geopolitical uncertainty. You are seeing a slight weakness when it comes to the renminbi, as well as we talk about that flight to safety back into the dollar as well, and that does maybe help the Hong Kong dollar a little bit here this morning. But then again, it is seemed to be right now a risk-off sort of day. You take a look at how oil stocks are doing. That certainly is tracking the price of crude here. So we talk about the shipping sort of angle to it and how they're on high alert. We saw, some of these shipping vessels make a U-turn around the Strait of Hormuz right now. So that is sending a little bit of shockwaves across the oil space here this morning on really what sort of response Iran can make, right? We just heard from Matt Gertken, who did say, at a point of, when Iran is backed to a corner, there's no saying that they won't do anything, right? That they might actually target the Strait of Hormuz. Whether it's a full closure or nothing, there's something in between, he says, that Iran can still do this morning or this next few days or so. PetroChina is up 1.8% right now, so certainly we are seeing that bid across some of the big players here this morning. So there you go. That is sort of the risk. Let's bring in Gerald Gan, Deputy Chief Investment Officer at Reed Capital Partners. You've been talking about this equity market has been in some way complacent, maybe not up until now. But why do you think it's only been focused on the FX and maybe commodity space?
Well, I think let's first talk about the equities market for a bit. So I think right now what we've seen is quite a bit of a complacency, right? So we've seen even before this, for the last couple of weeks, it has always been driven by narrative. All right. So, of course, even at this point in time, not just equities, but in the oil market has been driven by what? The volatility has been driven by what's going on in the Middle East. All right. So, I think all in all, what we see over here is that equities in recent times may continue to start to weaken a little, which is already happening. Right. So, in the last few days, markets a bit worried, a bit of jitters in the markets, thinking that probably this war may be something more sinister than what they expect. But of course, what we see right now is that the volatility is not really well reflected in the equities market, but it's more reflected in the commodities, especially for crude. All right. So for energy, it is the case, not so much on the other broad precious metals or even industrial metals. Yes.
Can you tell us a bit more about, you're still foreseeing some sort of market correction in the second half?
That's right.
What would that look like? You're saying it's almost like a house of cards right now. And what could actually topple that?
Well, I think why do I say that it's a house of cards is, of course, because, like what I mentioned earlier on, it's not driven, the recovery, the V-shaped recovery to be exact, wasn't driven by fundamental strength. It was caused by just narrative. With Donald Trump coming in, say, on X, on Truth Social, with this kind of what they call it, a taco trade, right, has been going on for the last couple of weeks. And we think it's not strength, it doesn't really show strength in the equities market. So when as we go into second half, especially, to be exact, I would say in Q3 of 2025 this year, we should see some really notable weakness, especially coming from the US real economy. Yes.
Gerald, David here. I want to get, just to follow up on that, and I want to get your sense of what you think about the past winners, or the current winners, given this pivot away from the U.S. I mean, granted, as you point out, there has been a recovery in U.S. markets, and that's really come, when you look at Europe and Japan, for example, people talk about the flows coming through from the U.S. to those places as more structural. How do I need to be thinking about that in light of what you mentioned, the house of cards analogy you mentioned?
I think at this point, this house of cards analogy I'm referring to also applies to the other equity markets, not just in the US, right? In Europe as well, in even Japan or even South Korea. Well, I think that in Asia, the recovery has been rather more extended. All right. So fundamentally, I think that on a global perspective, we still think that equities market would likely face some headwinds in the H2 of 2025. And of course, with this structural shift towards other economies, I think this is going to be rather short-lived in a sense, right? Because for the last couple of weeks, the markets got scared because of Trump's very volatile nature in his policies, or foreign policies to be exact, right? So moving forward, I think that there will be some normalization in the flows towards from what we've seen in the last couple of weeks. And then ultimately, with what I mentioned, that if let's say weakness starts to happen in the global economy, we will start to see flows going into treasuries.
Oh, okay. Well, I need to ask you then, U.S. Treasuries then, because I was going to ask you, if you're not invested in equity markets, what are you doing with the money? Is it cash? Is it short-term instruments? And do you think Treasuries are the way to go? Are Treasuries the most risk-free asset still out there?
I mean, in our opinion, yes, Treasury is still the risk-free asset. And I think since this whole debacle of Trump's very volatile nature in terms of how he ran his administration on the second term, it has caused a bit of stir and scare in the markets. But I think all this are just noises. Now, we really have to look at it in a 40,000 feet perspective. What's the next best asset, or risk-free asset, if you want to call it, other than the U.S. Treasury? Now, U.S. Treasury, in terms of liquidity and the depth of its market, it's actually the biggest in the world. So for institutional investors and whatnot to have to shift to other sovereign bonds, I think it's very unlikely, because those markets, for example, the bonds market is just 1/5 of the size of the U.S. Treasury market. So what we are seeing is that there's a very big constraint over here for that shift to happen. What I mean by structural change is that the word structural usually takes time to manifest. But I think right now, there's an overpricing of the downside of U.S. Treasury has been overstated for this period of time. So we are actually very overweight on U.S. Treasuries, underweight equities, and in fact, we are neutral on cash, because we expect the Federal Reserve to start cutting in the second half of this year.
The market is thinking maybe one. You guys are thinking 3 to 4 times.
Yes. Yes.
Can you walk us through that call? And that's quite out of consensus.
Okay. So it's quite far away from the consensus in the sense that we are 3 and 4, but right now market's saying 2, right? So what we've been seeing so far, even before the Liberation Day, what we've seen is that the U.S. market, especially in the private sector, has already been weakening, right? Jobs are losing, people are losing their jobs. Households are actually, in terms of savings rate has come down substantially. Not just that, delinquencies has been going up 30 days, 60 days, and 90 days. And of course, we are starting to see as well the wage growth is starting to slow down. All right. So all in all, we think that ultimately the real economy will start to show its ugly head, and then ultimately markets will say that, hey, it's really time for us.
You're not worried about inflation?
No. Inflation, in our opinion, is going to get to 2% target by the end of this year, right?
So Gerald, I'm looking at, there's, I believe, 4 meetings left as far as the Fed is concerned. So, I mean, I don't want to put words into your mouth. You're saying they're going to cut at every meeting. What's the trade in terms of Treasury? You said you're overweight. Do you go up in duration then?
Yes. Now, a couple of weeks ago, we shifted our view from, when it comes to duration risk, was in the mid duration, around 5 years to 5 to 7 years. Now, currently, at this point in time, we do like Treasuries a lot, and we've started to increase our duration towards the long end. Ultimately, average duration of around 9 to 10 years. That's where that's when we expect moving into second half of this year, or rather, to be more exact, Q4 of 2025. We think there will be a situation where the Fed realizes they are behind the curve, and then 3 to 4 cuts might likely happen in the last quarter of this year.
Gerald, fantastic. If and when we hear the Fed turn dovish, watch your phone. We'll be calling you shortly after that.
Sure.
Gerald Gan, thank you so much, Deputy Chief Investment Officer, Reed Capital Partners. Okay, Very quickly, the story across currency markets is, it's very, very simple. So we're going to go through this very quickly. At G10 FX, it's the dollar. All the way on the other end of the spectrum are like Norwegian krone, for example. You have the euro dollar, of course, on offer. The Kiwi dollar is one of the most under pressure currently. Very quickly, of course, Asian FX, it's the South Korean won. That is, no pun intended, the biggest loser. And then you have the Philippine peso, of course, that we did see, and we did hear, in fact, from authorities here in Seoul, where I am. They're looking at the currency markets very closely, and they, of course, will take any sort of action, if indeed, of course, that is merited. If is the operative word. Korean won leading declines and weakness across Asian FX currently. This is the China Show. Welcome back. You're watching the China Show. A glance at energy markets. So Brent, West Texas, and Shanghai crude all up, all gapping up in the early goings of Monday, although all are also coming off highs of the session. That's the context there. As far as Shanghai crude is concerned, at 586, 587 renminbi, that should put us at about the levels that we saw back in early Feb in terms of an intraday sort of level. But yeah, we'll continue to track that moving forward, of course, Yvonne.
Yep, and you take a look at this, we just want to broaden it out and put it into context here of really how big of a political or geopolitical risk this really is right now. We talk about how the sort of knee-jerk reaction has already kind of been pared back already. Yes, you're seeing some big moves now finally in the equity market, but in terms of the oil market, you compare the last few conflicts, right? Ukraine invasion, we actually saw the peak of Brent hit close to 140. The Hamas attack was around 94. Right now, we've just hit that peak at around $81 or so. So we're still kind of far away from where we were from these other sort of big events as well. And we're only right now back to the levels that we saw around June 13th, which was at the time that surprise attack by Israel. So just to put that into perspective, that what the moves that you're seeing and what's being priced in is still not as, I guess you could say, a massive sort of meaningful move than what we're seeing in previous sort of historic events. So certainly that's one to watch. And you have already seen that in terms of the volatility as well when it comes to implied vol in this oil market. That has also sort of pushed back a little bit here, but now we're coming back up. So certainly it's one to watch very closely. In terms of just what we're seeing, in terms of what the betting markets are concerned, everyone's been focused, of course, on the Strait of Hormuz. So what are the betting sort of odds right now? It seems like it's about a 50-50 sort of shot or odds here that Iran would actually make that sort of move towards closing the Strait of Hormuz. Those odds have now been about pretty even. It's interesting, though, right? We talked to the likes of Matt Gertken just now, saying that really it's not just kind of a all or nothing sort of move, right? There's things that Iran can still do, whether it's targeting ports or certain types of infrastructure that could still lead to disruption in supplies. So certainly that's still one thing to watch there, Dave.
Yeah, more likely than not, I think was the point that Matt was making, and I think he's actually put forward the fact that whatever your assumptions might be, I think a couple of things are clear, right? The one is an isolated Iran will tend to perhaps lean towards more disruptions in the oil market as a potential response, and certainly oil markets he thinks are kind of sleeping on that risk right now. Now, speaking of the Strait of Hormuz, as Yvonne was just talking about, there you have two super tankers capable of hauling about 2 million barrels of crude oil, which have actually U-turned in that part of the world. That's of course, the U.S. airstrikes on Iran have raised the risk of a response against commercial vehicles, something as well that Matt Gertken, who joined us earlier on, also pointed out was a possibility. Joining us now is Yong Chan-Chin, of course, our oil trading reporter, to talk us through this from Singapore. Well, why don't we start there? How big is the disruption we are seeing currently?
Hi. So, yeah, exactly. Yes, you were talking about shipping as being one of the first things that we're looking at in terms of, what the disruptions are, given, the latest U.S. attack on Iran and the region. So you have mentioned the two supertankers turning around. There are ships, waiting outside the Strait of Hormuz. So it's not like nothing is happening. As you mentioned, prices pull back. There's small sentiment that maybe, the worst is over. That's not quite true because we are seeing, instances of, say, signal jamming. So shippers are indeed, being much more cautious. It's much more reflected on, say, the LNG front, where you see LNG tankers also waiting. So. And with freight rates, shipping rates also rise, FFAs, they're all higher. So for sure, we are seeing a lot of disruptions on the shipping front. However, I would like to point out that, in terms of are there any significant loadings that have been disrupted yet? Not really. Ships are still coming in, coming out. We have seen reports, for example, that Iran is maybe speeding up loading some of its crude tankers. So, so for sure there is disruption, but I would like to emphasize, the threat, that people like to say, oh yeah, Iran's going to close the Strait of Hormuz. That's simply not happening yet.
Yeah, it's not. So what do you think traders are looking out for now then?
Yeah, so, in a sense, the worst isn't over yet. For sure, everyone's going to be looking for what Iran's going to do next, if the U.S. is going to come in and negotiate. Everything is still up in the air. There are definitely signs that people are trying to price in the risk. Obviously, the flat price, oil prices are much higher in the physical market as well. We see maybe a premium for some of the crudes that maybe load outside the Strait of Hormuz. So people are still trying to grapple with all that's going on in the physical market, in the financial markets, options, volatility, it's all higher. But as you rightly point out earlier on, everything is sort of, paring back a little bit. It's coming off just a bit, and maybe that's just the sense that people are not quite as worried as they were, before.
Yongchan, thank you. Yongchan Chen there, our Asia oil trading reporter, joining us out of Singapore. And we're going to have more on global trade and, of course, what this means in the shipping industry. Pacific Basin is joining us now, explaining why it's unlikely that Iran will close the Strait of Hormuz, even as a conflict with Israel threatens to extend disruptions in the Red Sea. The CEO, Martin Fruergaard, joins us in the next hour. This is Bloomberg. Well, the IMF Managing Director, Kristalina Georgieva, says the impact of the Middle East escalation on energy supplies and prices is a key concern. And she told us more about the rising geopolitical risks facing the global economy.
We are looking at this as another source of uncertainty in what has been a highly uncertain environment. And we are watching for two things. One, how would that impact risk premia for oil and gas? There has been some movement upward. How far would it go? And two, would there be any disruption in energy supplies? For now, no. But let's see how events would develop, whether either the delivery routes or spillovers to other countries may occur. I pray no.
Right. Is the transmission mechanism, the channels where you're seeing the biggest Middle East shock in energy prices at the moment?
It is in energy prices, yes. Of course, there could be secondary and tertiary impact. Let's say there is more turbulence that goes into hitting growth prospects of large economies, and then you have a trigger impact in a downward revision of prospects for global growth. As you know, we have already revised the downward growth projections for this year, and we will be coming up with our next projections in July. So far, what we see in the first 2 quarters of the year broadly confirms the picture we have painted in April, and it is somewhat slower global growth, but no recession. It is a very different world today than what we had right after COVID. Right after COVID, we had central banks going in a lockstep. Monetary policy opened up more space for injecting liquidity in the economy. So monetary policy, fiscal policy, all over the world, pretty much doing the same thing. Now we are in a very different place when monetary policy around the world has to go in different directions. We have in some countries monetary policy, some tightening. We see some countries actually losing, getting a bit more space through monetary policy. And that, why is this difficult? It is much easier if you can sit in your chair as a governor of a central bank, look around and say, everybody is cutting, I'm cutting as well. Or everybody is tightening, I'm going to tighten as well. Now we are in a place where everybody has to judge on data for their own conditions.
And that was Kristalina Georgieva there, the IMF managing director, speaking with Sherry An in Tokyo just a few hours ago. I just want to mark some of these lines are just crossing here right now. The president is going to be meeting with the national security team at Monday there. So we're talking about 1 p.m. Eastern time. I'm possibly seeing what the next moves are going to be from the U.S., but obviously what we're seeing in the markets is everyone's watching what Tehran is going to do. You take a look at how shipping stocks, for example, are doing here right now. Those in Korea, those in China are advancing, given just the U-turn some of these super tankers have made on the Strait of Hormuz this morning as well. So that certainly is the assumption that possibly that leads to freight rates to continue to head higher. You take a look at some of these shipping stocks here right now. That's where the direction is right now. And really the shipping industry overall has been put on high alert. Can we take a look at those shippers, guys? There you go. Ningbo Marine up some 10%. Gold miners also in focus given the gold price, and defense stocks are also heading higher this morning in the region. Well, a lot more on the way in the next hour. You're watching The China Show. Come back with some breaking news in the second hour of the China Show, where President Trump is posting on Truth Social here this morning and really talking about this U.S. strike over the weekend. And it's pretty much reiterating what we have heard so far from the U.S. that monumental damage was done to all nuclear sites in Iran, as shown by satellite images. The biggest damage took place far below the ground level, and obliteration is an accurate term. So that's what we're hearing from the president. But certainly there's still a lot of independent sort of inspections and analysis that still needs to confirm and verify these claims, Dave. And there's a lot about these strikes really creating a lot of a challenge to really work out what's left and where of the Islamic Republic's atomic facilities are what damage has really been done at the moment. But certainly when it comes to markets, you're starting to see more momentum in terms of selling this morning.
Yeah, when I look at the benchmarks, I think right now I just had a glance at my screens right now. So on the regional benchmark, Asia-Pacific benchmark, which we'll get to in a moment, defense stocks are catching a bit for obvious reasons. We're actually now at session lows with volumes starting to actually re-accelerate in the last 15 minutes or so. That might be down to the Hong Kong Open. It might also be down to the fact that you are getting some Southeast Asian markets coming online and reacting to this in their early minutes. Right. U.S. futures coming up on your screens. Just keep an eye on the 6,000 level. We've been hovering just above that for the most part of the morning. We dipped below that earlier on. We should be below that 6,000 handle on S&P. There we are. We're 3 points below that. And as you can see, all the way down to FTSE 100 futures, we're down about 0.5% going into, of course, the thick of the Monday session. So risk off on the macro board here on your screens. Hang Seng Index, we talked about that. 1% drop. Kospi also at about 1%, and also the Philippine Composite 1.6% now. Kospi's coming off lows of the day. Asia Pacific, which we talked about there, now in the order of about 1.1%, which is something we did see, of course, Thursday last week. So keep an eye on this as most of the region opens up and reacts to the developing story that we're obviously on top of, Yvonne.
Yeah, and of course, we're watching what goes on in the Middle East and who has spoken, what allies are saying. We did hear from the China response just a few hours ago. And Iran's Arab neighbors have also urged restraint as U.S. strikes on Tehran's nuclear sites raise fears of a wider war in the region. Let's bring in our Horizons Middle East and Africa anchor, Jumana Bersetti, joining us live from Dubai. Jumana, let's talk a bit more about what we've been seeing so far. When we talk about what the U.S. and the president is saying was a successful mission on their part. But what do we know in terms of what damage was really done?
Yeah, and I think that's the key question here, because right after the attacks, both the president, the defense secretary, Pete Hegseth, and pretty much anyone who's spoken out from the Trump administration has called it a huge success and that they've managed to devastate those nuclear sites in Iran. This morning, we got some updated information from the IAEA regarding the 3 sites that were hit. And so let me just bring you the outline of the analysis that IAEA put together based on satellite images. They had previously reported that several buildings at the Isfahan complex had been damaged, some which had already contained nuclear material. They report again that the latest attacks have damaged other buildings in Isfahan. And so it appears to be the case that serious damage was actually inflicted on Isfahan. Fordo, however, which, as we know, has the nuclear material deeply embedded in a mountain, more difficult to assess. The extent of damage to the Fordo uranium facility was not immediately possible to assess in light of its underground location, they say. And the Natanz previously also, they'd inflicted extensive damage via the Israeli direct attacks on the Natanz nuclear facility as well, sustaining some damage, was again attacked last night with ground-penetrating munitions. So putting it all together, I think it's fair to say that what happened over the weekend has constituted a major setback for Iran's nuclear program. But is it a complete obliteration, as President Trump framed it? I think that is debatable, not least because many experts in the space say that Iran, even days before these attacks, had managed to move some of the highly enriched uranium to other locations, unknown locations. They're still sitting on key material, key equipment, and crucially, know-how should they want to restart the nuclear program again at some point in the future. And so all of this is relevant because when you think about how long this war could go on for, and the U.S. are suggesting that it's not an open-ended war, if Iran decides to once again restart the nuclear program, would that then entangle the U.S. back into other action at some point again in the future?
Well, Jumana, David here, what could, at least over the next, let's call it few hours and days, what could retaliation look like from Iran?
And that's the big question. So the U.S., again, framed it as a targeted, perhaps surgical strike only on nuclear facilities, not targeting Iranian civilians. And therefore, will the Iranian response also be targeted, surgical in nature? Now, if you look at the language that's come out of Iran over the last 24 hours, they say that the door to diplomacy is now closed. They reserve the right to protect their sovereignty, and they will have to retaliate. So the question is how. Of course, we've talked a lot about the option of potentially causing disruption on the Strait of Hormuz. You'll notice that I use the word disruption, not closure, because legally, they're not allowed to formally close the Strait of Hormuz, but they can cause a lot of disruption there should they want to do that. And there was speculation rampant yesterday on social media that they may do that. But ultimately, the decision rests with the supreme leader, and he has not made a decision on that front. So if they want to go down that route, they could do it. But of course, as you guys were talking about, it also constitutes a major lifeline for the Iranian economy because most of their oil exports, which are being channeled towards China at this point in time, have to pass through the strait. Other options include targeting U.S. military sites, many of them dotted around the GCC. But again, that would constitute a major escalation because in recent years, Iran and GCC countries have tried to bring down the temperature in the region. They have mediated ties. So would they want to go down the route of actually attacking infrastructure in these Gulf countries? Again, big question mark. The other angle, and perhaps we can draw on from recent history, is what they did after the U.S. took out Qasem Soleimani. Remember, that was the Iranian military commander, was responsible for a lot of their foreign policy. This was back in 2020. And what they did then is they telegraphed the reaction to the U.S. They went on to hit a U.S. site in Iraq, not causing any fatalities, but still saving face that they had responded somehow. So we could be looking at a Qasem Soleimani option as well.
Jumana, Iran continues to stand alone, it seems like, in this conflict. Where are the proxies? Are they just refusing or unable to engage in this conflict?
I would say perhaps more of the latter, Yvonne, and you have to think about everything that has happened in the region since October 7 and the war that has been going on regionally, actually. And people are talking about the prospects of a regional war. There is a regional war going on. And in that time frame, many of those proxies have seen their own military capabilities diminished or eliminated. Hezbollah, for example, the main one that operated within Lebanon and, was engaged in conflict and war with Israel towards the end of last year. Well, since then, about 70% of their munition, their capabilities has been depleted. That is per Israeli military intelligence. Their leadership structure, their command structure has been wiped out. And you have a new Lebanese government that is pro-West, pro-Gulf states. They need to get back on track with the IMF program. They don't want to engage in a war. And actually, the language coming out of Lebanese leaders over the weekend suggests that Hezbollah are not going to be doing anything at this point in time. Now, whether U.S. military intervention changes things, that is a question. But for this point in time, they've been quiet. Syria, obviously, new regime there. You have a new government in place. Very difficult for Iran to continue funneling their proxies through Syria if they want to use the land route. And then Houthis, they've never directly acted on behalf of the Iranian cause, even though they're allies with Iran. They're much more prone to responding in support of the Palestinian cause. So far, you will recall as well that they had signed on to that truce with the U.S. a couple of months ago. Maybe this military intervention changes things. They have also threatened to once again disrupt shipping along the Red Sea. But bottom line is, most of these proxies have been quiet and are not showing either the appetite or the ability to engage.
Jumana, thank you so much for coming in early. I know it's going to be a very long day for you. Jumana Bersetti, there, a colleague, of course, co-anchor at Bloomberg, Horizons, Middle East and Africa. Let's get a sense of the oil markets right now. So we mentioned this earlier, gap higher across most. We're coming off highs a little bit, but certainly we're trading. Arguably, are we trading at a higher range right now because of events in the Middle East over the weekend? We're joined right now by Vivek, Dhar, mining and energy analyst at Commonwealth Bank of Australia. Vivek, good morning, and thank you for joining us. I know you've been busy and are busy today. My first question, what does the price action tell you about how the market's reacting to this?
So look, in respect to the prices, we've seen Brent start the day above 80, and it's come now down below $80 a barrel. And it's kind of trading in that range of 75 to 80, which we feel is almost taking some risk off, as it considers, in our view, two very polarized outcomes. One which is very much a symbolic retaliation, which is where they will do something where they telegraph to the U.S. what they're going to do, and that may actually result in that risk premium coming off even more. And if that is tied up together with an Israeli ceasefire as well, we're talking back to $60, $65 a barrel for Brent. And I think that's one real possibility given where we are right now, particularly if some of the reports are true that this attack on Iranian nuclear facilities was actually telegraphed by the U.S. to Iran. So I think that's really where that direction is going in terms of lower oil prices. But where, of course, everything can really turn upside down is if we see the more substantial retaliation, which could certainly see the Strait of Hormuz be weaponized. And in our view, it's very much not going to be a closure. It's going to look more like disruption. And I think the playbook you're going to use is something that the Houthi rebels showed through the Red Sea, that even the fear of attacks is enough to cause significant disruption. And that is something that, with drones and missile attacks, you could really cause a slowdown in tanker movement. And that could take your Brent price to about $100 a barrel. So we think 75 to 80 is a holding place. until we see the Iranian reaction, but you can see just how polarized this market is right now.
That's interesting, right? You don't really need a complex operation from Iran to actually, move those flows, as you're saying, Vivek. What should we look for in terms of just the disruption to oil supplies then? I mean, what sort of numbers are you kind of calculating right now?
So in terms of, what will happen, I think there's a question of reaction and then duration. And I think the reaction is where prices will spike. But clearly, if there is a lot of disruption in terms of the Strait of Hormuz shipping lanes, we're going to get U.S. and allied Navy involvement to protect the trade of oil and gas. Now, the question is that even if you do have that level of U.S. Navy involvement, and we have that in the Red Sea, the shipping traffic through the Red Sea is down 70% relative to what we saw in 2022-23. So having U.S. Navy presence there isn't necessarily the part which will magically make sure that oil and gas tanker flow is going to be back to normal and everyone feels secure. There is certainly risk that we're going to get depleted tanker movements, which, given you're dealing with 20% of global supply passing through that strait, the level of disruption from 3 to 5% in our view in terms of just of global supply, that's really where that $100 a barrel will really start emerging.
Yeah, and Vivek, can I ask you about that? Because the 3 to 5% will tend to give you a bad reaction if the oil market is tight, which this current market isn't. And correct me if I'm wrong there.
No, that's right. Look, the market so far, there's so many things to consider in terms of the moving parts. If I had to say what is really key in all this is if the Strait of Hormuz normalizes and we do still have tension, we still have to wait for what the OPEC plus strategy is on the back of all of that. Yeah. Now, we know that what they've done historically, and at least in the last few months, is they have been looking to target almost prices of $60 to $65 a barrel by claiming more and more market share. So if we do see the Strait of Hormuz actually become protected and disruptions are low, what Saudi and OPEC Plus do is also really critical in terms of price formation. So the problem here is Strait of Hormuz not only controls flows of Iran and a lot of OPEC Plus nations, but even all the spare capacity amongst UAE and Saudi Arabia sits within that strait. So, that whole waterway is make or break, and hence the polarizing nature of the market right now.
Okay. Vivek, maybe give us a little bit more about what this means for, you mentioned oil and the range that we could be seeing. What about for gold then? How should I be looking at gold now?
So look, so far I'd say what gold and US dollar have done, I think those are probably the two key safe havens that we watch in terms of how they're responding. US dollar so far this morning has held on to its gains, whereas gold has initially it crept up and then it's retraced lower. And so far, it looks like the US dollar is winning that safe haven demand so far this morning. Now, this is actually quite a change from what we've seen so far this year, where both the US dollar and US treasuries have really taken a hit, just given US tariff policy and the view that US institutions are coming under threat. And so that batting order of safe haven demand, which typically is US dollar, US treasuries as number 1 and 2, and then gold being number 3, has really been flipped this year, where gold has taken the number 1 spot. But that has really been amongst this idea of US leading to its own decline and the whole tariff policy, whereas this geopolitical threat is different, and it's a hallmark of what we've seen historically. And this may actually see US dollar do better than what it has so far this year in terms of safe haven demand flows. And so this is something we're watching pretty closely, because if US dollar does rise, that's actually slightly negative for gold in our view. So it's something that I don't think gold will benefit just as much as it will. But if attention comes back to the US and what the tariff policy is, and we think that's imminent just given the July 9 deadline for setting tariffs on 60 right. economies, that is going to be bullish for gold, and in our view, taking it to about 37.50 by the end of the year.
Yeah, Vivek, we can't even look at this in a vacuum, and certainly there is, to your point, a broader tariff conversation that's still taking place. In a couple of minutes, Vivek, we will be joined on the show by the CEO of Pacific Basin. They, as perhaps you know, they they're in dry bulk, you're in commodities and materials and mining. What do you think we should ask him?
So in terms of how do disruptions like this really take hold? And what are the tipping points where we should be worried? Because they'll see signals in the market that no one else will. So what are they watching in terms of taking their insurance and then playing the market differently? So that would be, for me, very much the key questions I'd be asking.
Vivek, thanks for helping us with that question. We're definitely going to try to ask Martin that. Vivek Dhar there, mining and energy analyst at Commonwealth Bank of Australia, joining us there talking about what to expect. Now, we're watching some moves when it comes to FX, and we're hearing from the Bank of Indonesia here this morning, and they are saying that they did, in fact, intervene in their offshore and onshore markets. So they intervene in the spot, offshore, and domestic NDF and bond markets here. We are seeing the rupiah falling along with the regional currencies here on the back of this kind of risk-off sentiment, as Vivek mentioned, that dollar regaining its haven status once again. So Asia FX certainly is feeling it here this morning. And first of all, we're talking about the yuan certainly leading that charge here today, but rupiah certainly is joining in on the fray here as well. But yes, central banks speaking out much more and intervening this morning. Plenty more ahead. This is Bloomberg. Well, China has criticized the U.S. strike on Iranian nuclear facilities, saying again that it's willing to join international efforts to restore peace in the Middle East. And U.S. Secretary of State Marco Rubio is calling on Beijing to ensure Iran keeps the Strait of Hormuz open.
Well, I encourage the Chinese government in Beijing to call them about that because they heavily depend on the Straits of Hormuz for their oil. If they do that, it'll be another terrible mistake. It's economic suicide for them if they do it. And we retain options to deal with that. But other countries should be looking at that as well. It would hurt other countries' economies a lot worse than ours.
Let's bring in our China correspondent, Min Lo, with talking about that Beijing response and this urge for more diplomacy, it seems. But realistically, how much sway does China have in this whole conflict?
Yeah, China does, as we know, buy a lot, pretty much all of Iran's oil. And it's a very uneven balance of power here because 90% of Iran's oil is bought by China, but that still constitutes maybe, by some estimates, maybe just about 15% of China's total oil imports. So if you look at where China imports the most crude from, number one is Russia, followed by Saudi Arabia. We have a chart on that if we can pull it up. Iran is actually not in Chinese customs data because of sanctions. It is among the top few importers, but still not the biggest. So China does have significant leverage, but for Iran, if you look at its total exports revenue, 85% of its revenue comes from energy exports. So in some ways, Marco Rubio is right. If they do close that Strait of Hormuz, it is in some ways economic suicide for Iran. So it is a last resort move when push comes to shove. But before that, as analysts have said, there are other ways that Iran can retaliate by attacking vessels and ships. It can disrupt oil supply from Iraq, for example. But what is clear at this point is that the stake is high for China. If it does engage in this war, it will be engaging essentially in a proxy war with the United States. And it's very careful about not attracting secondary sanctions from the U.S. for providing material support to Iran. And if you look at all the external shocks or uncertainty that China is facing, analysts are saying that still tariffs is the number one source, more so than higher oil prices.
So, Min, how is the issue and story being viewed domestically in China?
Yeah, I think this is very interesting because a lot of Chinese people are looking at what is happening in Iran, and they're taking a lesson from that. And the lesson is that the U.S. is not a trustworthy party. A lot of that comments are saying how Iran is being duped by the U.S. It's being naive to believe that U.S. would be there to mediate. And some comments are saying that essentially this is an example of how Iran is being squeezed by the U.S. There you go. Americans are the least trustworthy. So this holds a lesson for China that these appeasement tactics, they don't work. Only by fighting resolutely can you really maintain your sovereignty. And this has implications over, for example, how China is going to deal with issues like Taiwan when it comes to tensions with the United States. When it comes to the Middle East conflict, though, China still has this long-standing policy of non-interference, so it's not likely to want to put actual resources into that war unless its sovereignty is directly threatened.
Min Lo, thank you so much, our China correspondent there. For Bloomberg subscribers, you can turn to your terminal for more on the story, really context, the different angles and vectors surrounding the story, and certainly we're following all those in parallel given how fluid the story is going currently. So check it out, of course, on your Bloomberg terminal at the function you see bottom of the screens, and it also gives you the latest at this point in time. Plenty more ahead. This is The China Show. Welcome back. We'll start things off with some fairly important lines coming through out of Thailand here. So the exchange is coming out with some context. Let me just give this some time, and we'll talk only about this now. So about 2 hours back, the exchange announced that it was trimming the daily price limit of stocks to 15%. We're now hearing from the stock exchange president talking at a briefing that they may be looking to end those share price curves before June 27. The context here is certainly the global risk aversion taking place and Thailand almost being at the center of that as the worst performing stock market globally year to date. That's the context. That's the latest. Plenty more ahead. You're watching The China Show.
I think that would be suicidal, Kristen, for the Iranians themselves. I mean, their entire economy runs through the Strait of Hormuz. If they want to destroy their own economy and cause disruptions in the world, I think that would be their decision. But why would they do that? I don't think it makes any sense. I don't think that it makes sense for them or for anybody else. What would make sense is for them to come to the negotiating table to actually give up their nuclear weapons program over the long term.
The world must not forget that it was the United States which, in the midst of a process to forge a diplomatic outcome, betrayed diplomacy by supporting the genocidal Israeli regime's launch of an illegal war of aggression on the Iranian nation.
We have a window of opportunity to return to dialogue and diplomacy. If that window closes, violence and destruction could reach unthinkable levels, and the global non-proliferation regime, as we know it, could crumble and fall.
The bombing of Iranian nuclear facilities by the United States marks a perilous turn in a region that is already reeling. From the outset of the crisis, I have repeatedly condemned any military escalation in the Middle East. The people of the region cannot endure another cycle of destruction.
Officials from Washington, Tehran, and the United Nations, they're reacting to the U.S. strikes on Iran and some other stories that we're following for you this morning. Major U.S. cities, including New York, Washington, and Los Angeles, are tightening security after Iran warned it was, quote, reserving all options to respond to the U.S. strikes. Police have increased patrols at religious institutions, diplomatic facilities, and public spaces. Officials say no credible threats currently exist, but are urging people to be vigilant. British Airways and Singapore Airlines have canceled flights to the Persian Gulf after the U.S. strikes in Iran. BA canceled several flights to Dubai, including diverting 2 planes. It also halted some flights to Qatar and Bahrain. Singapore Airlines, meanwhile, canceled 2 flights on Sunday between Singapore and Dubai, warning other flights may also be affected.
Right. Let's have a look closer at the story here. The Strait of Hormuz, of course, is front and center, and the possibilities around there. I have to underscore the possibilities around that part of the world. What we do know so far is, 1, 2 super tankers capable of hauling about 2 million barrels of crude each have U-turned in that part of the world. maybe underscores the risk to commercial, that's a question mark, commercial vessels. Let's bring in our oil reporter, Nicholas Lua, who joins us from Singapore today. And what risk does the U.S. involvement now, Nicholas, pose to shippers specifically?
So I think what's important to recognize is that the U.S. Strikes on Iran represent an escalation on threats in that region. All eyes are on any possible retaliation for Iran, which has threatened to close the Straits of Hormuz. Now, whether that's feasible aside, I think one question remains, which is namely that, okay, if such an escalation would happen, then shipping, so about more than 20% of oil flows through those straits, and any disruption could be disruptive for global markets.
Nicholas, we haven't heard anything from the Iranian side, and you talk about there's many options still on the table, but tell us what you're seeing in terms of what vessels are doing. Why do you think ships are already turning away from the Strait of Hormuz?
I think the threat level has certainly escalated since last Friday. That's also what we're hearing from traders who handle the market. Freight has already come up by tremendous levels. Now, I'd like to point out that what the ships were doing is very clear, right? So on Sunday, they were sailing towards the straits, and then all of a sudden, they start turning around and sailed out of the Persian Gulf. So I think we can read that as the first signs that flows are being rerouted away from the Persian Gulf, a major oil exporting region.
Nicholas, thank you. Our oil reporter Nicholas Lua there with the latest when it comes to what we're seeing in the Strait of Hormuz. Let's bring in our next guest. Pacific Basin, a major owner and operator of dry bulk ships. Joining us exclusively is the CEO, Martin Fruergaard. Martin, it's great to have you back on the program. Obviously, you've seen it all. We've already under multiple wars, including a trade war at that. There's a lot of uncertainty out there. How do you see global trade evolving or changing through all these different events?
Yeah, but definitely in my lifetime in shipping, this is part of our business, the disruption we see again and again. And maybe at the moment there's a little bit more than what we are used to. Our market is basically driven by global growth and global trade. So, of course, the conflicts in the Arabian Gulf does have an impact on our business. Maybe less on dry cargo. Yeah. Only 2% of dry cargo of the total volume goes into the Arabian Gulf. Maybe the Red Sea is probably more a player in our market. We are, in general, in the longer term, positive. We think global growth will continue. We've seen it again and again. There's disruptors that changes the demand flow, but in the longer term, the world population is growing, and the raw commodities that you need in the world is what we move, and normally we'll see a positive trend on that side.
How do you see the disruptions take hold, though? I mean, have you seen difference in vessel movements, flows? I mean, what are the trends that you see?
In the dry cargo space, of course, first of all, the Red Sea, we saw that most owners will not go through the Red Sea due to security issues and the concern for the crew and the ships, of course. We actually, a couple of weeks ago, did evaluate to go through again. That have, of course, changed now with the situation escalating in the Arabian Gulf. We have also stopped at least committing to additional voyages into the Arabian Gulf as the situation is so uncertain, that we are waiting for to see what's going to happen next in that situation. And the immediate effect on the dry cargo space, I think, is probably more that the oil price will go up, so fuel prices will go up. That means that the ships will probably go a little bit down in speed. There'll be less supply, but that's typical in shipping. That one thing happens here, it does influence the rest of our business.
So what do you think, if you look longer term, the challenges that it might present, or even the opportunities, and who comes out as the winners and losers in all this?
Well, I think the disruption normally for shipping companies, sadly to say, is a positive thing.
Yeah.
It normally ends up, maybe at the moment, the Strait of Hormuz is probably more tankers than dry cargo ships, but normally it does have a positive. This disruption does create volatility in the short-term market, which normally is good for the shipping company. Of course, in general, when you look also at the tariff war and other conflicts at the moment, we're a little bit worried that will have a negative impact on global growth. And of course, fundamentally in the longer term, global growth is actually what drives our business.
Martin, David here. Yeah, in fact, we want to get a sense a bit later on what you're seeing as far as growth, particularly some of the routes into China. But I just need to pick up on one thing that you said. You mentioned the potential pass-through to your part of the woods would be through higher energy prices. I noticed freight rates have come down. Do you get a sense that you would be able to pass that on if indeed oil prices, energy prices globally were to go up substantially?
Yeah, well, I think to a certain extent you would do that. It of course depends on supply demand for the ships. That's probably more driver of the cost. But normally the fuel cost is something we pass on to our customers. But I think the immediate effect is probably that we will slow down a little bit to reduce the consumptions of the ships in that way.
Can you tell us where you see rates moving then, maybe in the next year, particularly when it's coming at a time when the market, you're expecting a large number of new buildings in the Ultramax sector that are going to start to be delivered?
I think when we started the year, we were probably a little bit more cautious, a little bit more nervous about the market because we had a 4% growth in supply and basically a somewhat lower demand growth in it. And again, I think we also said that to the market. The disruptors is hard to predict, of course, and we have seen them come again and again. And they do actually take some supply out of the market. That it can be the war in the Arabian Gulf, but definitely also the tariff discussions, China, U.S. We see China not importing any grain from the U.S. It's now turned into being carried out of Brazil. That's a longer ton mile for us. So again and again, we see these things actually helps us in a market. Also, when we have a little bit higher supply than demand, that we foresee this year at least.
Can you tell us a bit more about what you're seeing in the Chinese economy right now in terms of the demand picture?
Well, it's actually surprisingly stable. The beginning of the year, volumes were down. That's basically because they had taken large inventory, maybe in expectations of this tariff war, especially on coal and iron ore and grain. But here in May, we have actually seen improvements again in the volumes, and they're back, and they're actually now a driver of demand in our space. Outlook for China, we're positive that the economy, we don't see it as a sort of growing a lot, but we actually see it being quite stable, and we probably see them on their way out of the slowdown they have had for a while. We definitely see coal has peaked. Consumption of coal in China has peaked. It's now replaced by renewable energy. Yeah. So a lot of things are happening in China that, of course, indirectly or directly have impact on our business.
And of course, for you guys, the big impact is trade. I have to ask you about this Section 301 investigation on China's maritime logistics and shipbuilding sector. Do you think it has what it takes to in some ways, revitalize the U.S. shipbuilding industry and albeit hurting China's? I mean, how do you see this all playing out?
Well, the USTR 301 will not have any impact in respect to where the ships are built. It's a little bit of a hassle for many of us to comply with the regulation, and it's a little bit uncertain exactly how it will end up in that sense. But I think what it actually does is that, again, it creates this uncertainty that the tariff discussions and the conflicts, that everybody steps back a little bit and stop buying and investing in the industry. So what we see now is that new ordering of dry cargo ship is 10% of what it was last year. So people are stopping up. Logically, of course, with this uncertainty, you stop up and you don't want to put the money into. So we are probably underinvesting in new ships in our segment, which can be positive and will be positive in the longer term. But in the short term, of course, we are sitting on the cash waiting to see what happens next.
So maybe no impact. Is that a signal then that maybe China's shipbuilding industry is just too far ahead?
Yeah, I would say so. I think that they are probably plus 70% of the new building. When you go to, I've been to Shanghai a few times and see the yards. These are super modern, automated yards. The entire infrastructure on the Yangtze River and so on. That's just going to be hard for anybody to beat in it. So, and I think it's fair to remember as well that the Chinese new building industry have, of course, provided us cheap transport for 20 years. So there's also some good thing about it. But I also understand that it's never nice when one country is dominating in one area. So I'm sure something will happen in different places.
Martin, I can't help but notice, because it's glaring me straight in the face, your stock price now is up 15% just today, which we're just using our math here. That's currently the single biggest jump in your stock price in 9 years. Now, I have to ask you a related question to this. Might be related, might be not, actually. Caravelle has actually built up, based on last filings, a 13% stake in the company. Are you in talks with Caravelle? Are you open to a merger or being purchased by Caravelle? Just to ask you directly.
Well, first of all, I think we're very happy that our share price is up. We have long been saying that our share price is undervalued, and we have actually done share buybacks both last year and also this year to support the share price. And we're also glad that actually a very industry knowledgeable investor can see value in Pacific Basin and like to invest in it. And I must say they've done quite well in their timing of their investments in Pacific Basin. So well done by them. They now own 13%, and we have two other American funds who owns 12 and 12.5% of the company. We are, of course, in dialogue with Caravelle also because they are located here in Hong Kong and are very known to us. So, of course, there is an ongoing discussion with them in that part.
Well, discussion regarding what?
Well, an ongoing discussion about the general market. Of course, our job is, of course, to make sure that we run the company the most optimal way, and we are glad that the shareholders investors buy our shares. Exactly what the end game is on that part of it, of course, it's very hard for us to predict in it. But we do what we think is the best thing to do for all our shareholders, also our new shareholder.
Martin, thank you so much for being so candid with us. Martin Fruergaard there, CEO at Pacific Basin, joining us here in our Hong Kong studios. We have more on the Middle East coming up on Insight with Hezlin Ahmed. She's going to be discussing the prospects for Iran's nuclear program with the University of Southern California and the Foundation for the Defense of Democracies. Plus, Lippo Oil Associates and JP Morgan Asset Management examine how fresh geopolitical risks are rattling markets. This is Bloomberg.
I don't think the job is finished. I think it's very difficult to make evaluations of how effective we've been, for example, at Fordo, which by definition was under a mountain. It's very difficult to see inside. But my guess is that what the chairman of the Joint Chiefs, General Kane, said is accurate, that there was severe damage. We'll be checking further and seeing.
I tend to believe that Donald Trump himself is not seeking regime change. He is seeking, as he said very clearly in his statement from the White House on the night of the attack yesterday, that he wants to make sure that Iran does not have the capability to get a nuclear weapon. But there is a lot of conversation within the Republican Party about whether there should have been an attack at all on one side, and on the other side that since we've done this, maybe there's something we can do to push the Iranian people to rise up or to change the regime.
I think these strikes and other counter-proliferation methods like sabotage and cyber attacks and assassinations can damage the capabilities of the Iranian nuclear program, but it's really difficult to interfere with the intentions. So Iran might be more determined to proliferate, and it's going to be hard to strike that knowledge, right? And that knowledge base that is just there around uranium enrichment and the reactor technology and the fuel cycle that's sort of necessary for sustaining nuclear fission.
Just some of our guests today are, in the recent hours, here reacting to really what's been taking place, U.S. airstrikes on Iran over the weekend, and perhaps where we go from here with that specific story. In fact, just on that note, the IMF, the managing director, Kristalina Georgieva, says that the impact of the Middle East escalation on energy supplies and prices is a key concern. Now, she told us more about the rising geopolitical risks facing this global economy.
We are looking at this as another source of uncertainty in what has been a highly uncertain environment. And we are watching for two things. One, how would that impact risk premium for oil and gas? There has been some movement upward. How far would it go? And two, would there be any disruption in energy supplies? For now, no. But let's see how events would develop, whether either the delivery routes or spillovers to other countries may occur. I pray no.
Right. Is the transmission mechanism the channels where you're seeing the biggest Middle East shock in energy prices at the moment?
It is in energy prices, yes. Of course, there could be secondary and tertiary impact. Let's say there is more turbulence that goes into hitting growth prospects of large economies, and then you have a trigger impact in a downward revision of prospects for global growth. As you know, we have already revised the downward growth projections for this year, and we will be coming up with our next projections in July. So far, what we see in the first 2 quarters of the year broadly confirms the picture we have painted in April, and it is somewhat slower global growth, but no recession. It is a very different world today than what we had right after COVID. Right after COVID, we had central banks going in a lockstep. Monetary policy opened up more space for injecting liquidity in the economy. So monetary policy, fiscal policy, all over the world, pretty much doing the same thing. Now we are in a very different place when monetary policy around the world has to go in different directions. We have in some countries monetary policy some tightening. We see some countries actually losing, getting a bit more space through monetary policy. And why is this difficult? It is much easier if you can sit in your chair as a governor of a central bank, look around and say, everybody is cutting, I'm cutting as well. Or everybody is tightening, I'm going to tighten as well. Now we are in a place where everybody has to judge on data for their own conditions.
And that was the IMF Managing Director, Kristalina Georgieva, speaking to Sherry in Tokyo. We got plenty more ahead. This is Bloomberg.
There's about 10 million barrels per day, very roughly, of spare capacity. If the shock is beneath that, then you get a price move, but then you get that price move coming back down because there's still enough spare capacity to adjust. But if you get above that, meaning that if Hormuz is closed, or if shipping in other ways is blocked, or if Saudi Arabia is hit, those are last gasp actions by Iran. But if they happen, then of course we would start to move toward maybe even a doubling of oil price. I mean, definitely over 100 per barrel.
It's kind of trading in that range of 75 to 80, which we feel is almost taking some risk off, as it considers, in our view, two very polarized outcomes. One which is very much a symbolic retaliation, which is where they will do something where they telegraph to the US what they're going to do, and that may actually result in that risk premium coming off even more. And if that is tied up together with an Israeli ceasefire as well, we're talking back to $60, $65 a barrel for Brent.
Some of our guests there reacting to the U.S. airstrikes on Iran over the weekend and really kind of gaming what scenarios to actually look ahead to, right, in the coming weeks or months. But, Dave, it's very interesting, right, because we talked about the whole Strait of Hormuz. Multiple guests have come on the show and basically have said Iran doesn't need a full closure of this area for it to lead to any sort of disruptions. You don't need a complex sort of operation. And you already are seeing some super tankers avoiding that area altogether. So, disruption of supplies is certainly something that we need to deal with. The degree of it, which is certainly what was debatable right now. But there's a lot of guests are also saying, right, that the worst is behind us sort of scenario that seems to be, happening in the markets here right now. You kind of have to warn against that right now.
You do, right? How probable are the tail risks at this point in time? You don't need a natural blockage to get disruptions, I think is the point that you just mentioned there as well. And, not to mention the in what way will the U.S. get involved if we do get to that extreme scenario? Because, of course, oil prices are not good for everybody, with the exception, I guess, if you're a producer. But that being said, of course, the other thing there, speaking of intervention in markets is something that's come up today. Indonesia's intervened in the markets to stabilize things. The South Koreans, where I am here, the Bank of Korea has talked about looking very closely at the markets given everything that's taken place. And the Thais, the top state of Thailand, market opens up in a couple of minutes. They're also looking at tweaks there to some extreme moves. That's it from us. We'll see you all tomorrow.